Ron Parks here and welcome back. Let's talk today about a 30-year versus a 15-year mortgage and which one might be better for you. Now, if you're lucky enough to buy your home in cash, this won't apply. But according to Freddie Mac, in 2019, 90% of people got a 30-year mortgage on their home. Now, mortgage terms impact the cost to you. So let's talk about what a mortgage is. A mortgage is simply a particular type of term loan, one secured by real property or your home. For a term loan, the borrower pays interest, which is calculated on an annual basis against the loan's outstanding balance. Both the interest rate and the monthly payments are fixed if you get a 30-year or 15-year fixed loan. Now, there are a lot of other loans which are variable rates and they fluctuate, but let's focus today just on the 15 and 30-year. The most popular options are a 30-year mortgage or a 15-year one. And most Americans used to think of 30-year mortgages as the only option, but that's far from the case now. So choosing between a 15 and 30-year mortgage will depend on your particular situation. They are structured very similar, with the main differences being the length of time, the amount of the monthly payment, and what interest rate is charged. Now, each has its advantages, including the types of situations that they are best in. And I'll compare 30 and 15-year products across a few key aspects to help you figure out which one you should choose. So let's go through the differences. Monthly payments and loan term. Whether you opt for a 30-year mortgage or a 15-year mortgage, you'll have to pay off the principal, which is the mortgage's official value, and you'll have to pay interest. Now, principal and interest that's applied to the mortgage will vary from year to year, and it all depends on a number of factors which we'll go through. So over the loan's lifetime, the proportion of your monthly payment towards the principal and the amount going towards interest will change. Most of your payment will be interest due to the high balance that you start with. And as your mortgage balance decreases, the payment amount for the interest will also decrease. So more of your monthly payment will go towards principal as the years go forward. Now remember, in the later years, you'll see a significant reduction in the principal as more of your payment will reduce the principal balance and less will go towards interest expense. So how does loan terms affect monthly payments? 30-year mortgages have lower monthly payments, assuming that the total amount you need to pay off the mortgage is the same in either situation. A 15-year mortgage would have higher monthly payments than a 30-year one. After all, you need to pay off the same amount of money in half as much time. So this makes logical sense. The lower monthly payments associated with a 30-year mortgage can have numerous benefits. Most importantly, they make it easier to afford the home you want, whether that means a larger house or one in a better neighborhood. The lower monthly payments may even be the factor that lets you own the house and get approved. That lower monthly payments let you save more money for emergencies or other goals like retirement. And you also need to consider that you have a better chance of always making your mortgage payments on time if they're lower, which will reduce your risk of default on the loan. With the significant differences in loan terms and monthly payments, 30 and 15-year mortgages each have advantages in one regard. Now, the 30-year mortgage has lower monthly payments, as I mentioned, making it more affordable. However, the 15-year mortgage has a shorter loan term, so you'll be out of debt much sooner, assuming you make prompt payments. Now, there's also differences in interest rates between a 15 and a 30-year. Now, 15-year mortgages have lower interest rates. Although interest rates will vary significantly based on the market you're in, how much you put down, and your credit score, it's common for 15-year mortgages to have better interest rates than 30-year mortgages. Now, that's because a 30-year mortgage represents a greater risk to the bank because it's a longer term, and it costs banks much more to service a loan due to the longer term nature of the loan. A reduced interest rate for a 30-year will have some drastic savings over the loan term. Even if you were to get the same interest rate on a 15 or a 30-year mortgage, the 15-year mortgage would cost less in the long run. Now, this can be counterintuitive at first, as the longer mortgage has lower monthly payments. But the fact that you make those payments for twice as long, combined with the interest, makes a significant difference. This is made even more prominent because a 15-year mortgage tends to have lower interest rates. To illustrate, consider a 30-year mortgage loan of $500,000 with a 3.5% interest rate, okay? Or a 15-year loan with a 3.5% interest rate. Okay, the loan's the same, the interest rate's the same. In terms of just the mortgage payment, the 30-year mortgage would have a monthly cost of $2,245. Now that's compared to almost $3,500 of a monthly cost for the 15-year loan, which is way, way higher. Now this confirms the previous point that I talked about, that 30-year loans have lower monthly payments. But you see how much more they cost in the long run when you extend it over the loan's life. So paying 30 years worth of monthly payments at, let's say, $2,245 with your 3.5% interest rate will end with you paying a total interest of over $308,000 on the $500,000 mortgage that you borrow. By contrast, paying 15 years worth of $3,500 monthly payments with the same 3.5% interest rate will result in you paying interest totaling $143,000 over the life of the loan. So in this example, you'd spend $112,000 more overall on your 30-year mortgage than you would on a 15-year one. Now that is a sizable number. Because mortgage loans include compound interest, they're a little tricky to calculate by hand, but luckily there's an abundance of mortgage calculators online that will do the math for you. So I encourage you to plug in the numbers for your theoretical 15 and 30-year loan to see how much you'll save by opting for the 15-year versus the 30-year. Now let's talk about building equity, because one of the great things about owning a home is that you build up equity in the house. So another thing to consider as you debate the two types of loans is the rate at which you'll build equity, which is likely one of the primary reasons that you want to buy a house. And for every mortgage payment, part of the payment goes towards interest charges and part goes to reduce the principal balance, which is where you build up equity in the property. And if you look at an amortization table of 15 versus 30 years, you'll see that with a 30-year mortgage, the principal reduction is minimal at the beginning and only picks up speed during the later years of the loan. But with a 15-year term, principal reduction starts immediately and grows much faster due to the shortened term in which you have to pay off the loan. Now you can go to bankrate.com or NerdWallet, and they have great mortgage calculators that you can plug in numbers and play around and see what might be better for you. So continuing the previous example of a $500,000 mortgage at a 15-year rate of 3.5% or a 30-year rate of 15.5%, take a look at where you'll be in terms of equity in 10 years. Well, at this point, you'll have gotten your 15-year mortgage principal down to around $378,000. But the 30-year mortgage would still have a balance of about $196,000 more. So at this point, you'll have gotten your 15-year mortgage principal down to around $196,000. And with the 30-year mortgage, you'd still have a balance of $378,000. So with the 30-year loan, you have reduced the principal only half of what you would have accomplished with the 15-year loan. Because on the 30-year loan, we don't see significant principal reductions until year 11. But with the 15-year mortgage, we start seeing a principal reduction in year 1. Now, for many people who want to build equity, this difference makes it well worth paying a little extra each month for a 15-year loan. Okay, so let's think about it this way. Which is the best mortgage to do if you're selling your home fairly soon? Well, a 15-year mortgage is better, because both the rate at which you build up equity in your home and your total mortgage payments for the loan will also be a factor if you plan on selling your home before you have fully paid off the mortgage. And in this case, there's a better chance that you'll not be underwater or owe more than the value of your home if you have a 15-year mortgage, as you have built up equity faster. So let's summarize the differences as a quick recap before getting into when each type of mortgage is better. Well, the following are the main differences. Monthly payments are higher with a 15-year mortgage. Lower payments on a 30-year mortgage let you save more money for emergencies. Now, you pay off a 15-year mortgage in half the time, and interest rates are lower with a 15-year mortgage, and you pay less overall of interest with a 15-year mortgage. You build equity more quickly with a 15-year mortgage, and if you sell your home shortly, your loan has a lower chance of being underwater with a 15-year mortgage. And going back to tax deductions, well, a 30-year mortgage is much better for tax deductions. So if you choose to itemize your taxes, then you can deduct interest on a home loan that's less than $750,000. Now, given that 30-year mortgages have higher interest rates, this results in a larger deduction on your taxes than a 15-year mortgage. But the thing to keep in mind here is that this benefit only applies if you itemize your deductions instead of using the standard deductions. So when is a 15-year mortgage better? Well, a 15-year mortgage is better if you can afford the higher monthly payments, as you'll be able to pay off the loan more quickly, build equity, and pay less overall. It is also the right choice if you plan on retiring in the next 15 years or so and want the mortgage paid off before you do that. And the key here is that you have to qualify for a 15-year mortgage, proving to the lender that you can make the higher monthly payments. And when is a 30-year mortgage better? If you can't afford the higher monthly payments of a 15-year mortgage, then you have to go for a 30-year one. It is better to wait longer to own your home outright and pay more overall than it would be not to make monthly payments and have your home foreclosed if you took a 15-year. The lower monthly payments make 30-year mortgages an excellent choice for those with incomes that changes or for younger people whose incomes are not as high yet. So is there a middle ground? Yes, of course there is. Now here's the best of both worlds, is what I did for my mortgage. Look for a 30-year mortgage, but be sure to select one that has no prepayment penalties. Now some loans have a penalty if you pay them off early, but you don't want one with that, because if you got a 30-year mortgage, you can make larger monthly payments every month on a 30-year mortgage, such as those that would be more in line with a 15-year mortgage, letting you pay off the debt and build equity more quickly. Then if your finances get tight, you can go back to the minimum payments for your mortgage without consequences or risk of foreclosure. Now this method lets you adapt your payments based upon your changing financial situation. Now remember, you have to ensure that there are no prepayment penalties or they're really low for it to work. You'll also still have a higher interest rate associated with the 30-year mortgage. So which one's better for you? Well, a 15-year mortgage is a better choice for people if you can afford the monthly payments and are confident that you'll do so for years to come. The interest rate difference could be significant, and saving interest expense during the entire loan will be much lower. And if you can handle the increased payments, then opt for a 30-year mortgage without prepayment penalties and make extra payments whenever you can afford to do so. So this summarizes the basics between a 15-year and a 30-year mortgage. I can't tell you which one is right for you, but you'll know as soon as you go to a mortgage broker or to a bank to qualify for one, because they'll tell you whether or not you can afford the larger payments or the lower payments. Now, to be conservative, it's always better just to get a 30-year mortgage, and if you have extra funds, pay it off as if it was a 15-year mortgage, which gives you the same outcome, except you'll have a little higher interest rates. So I hope this helps, and I appreciate you listening. And if you like the video, please smash the like button and subscribe. And until next time, thanks.